Good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. And unlike Fikile Mbulula, we start on time always. The Trump administration calls it strategic uncertainty, but it continues to unsettle markets. The trade tariffs, is it on or is it not? Surprisingly, the value of the dollar is under pressure in times of uncertainty, despite US bond yields also moving higher. With a lot of assets moving to other safe haven currencies like the Swiss franc, the yen, assets also moving to gold. Gold price keep on going up, and some assets even moving to Asian markets. Are we starting to see the de-dollarization, or what is this all about? Trump wanted a weaker dollar to support US exports, and a couple of months ago we said, but with trade tariffs, it's really not supportive of a weaker dollar. But here we are. The dollar is trading weaker, and is this perhaps by design? And especially with interest rates remaining higher, is South African money market funds, by way of example, perhaps a good idea to keep some funds as dry powder? How do we maintain good portfolios in the current environment? This and more in our session today. And it's my absolute pleasure to welcome Executive Director and Investment Manager at Platinum Portfolios, Mel Meltzer, and Anthea from Cartesian Capital, Founder and Managing Director, will join us as well. Mel, good morning. How are you?
Good morning. I'm well, Eugene. I'm well.
Thank you so much for joining us this morning and the time you took in preparing for these sessions. We know it always takes a bit of time, and things are busy at the moment. Mel, I can see a presentation coming up. We'll just put it in full presentation mode. If you're ready, we can start. After you, Anthea will present, and then we'll take a few questions from the audience as well. Thank you so much.
Thank you very much, Eugene, and welcome everybody. And thank you for the opportunity by joining you guys on Boutiques on Wednesdays. And I'd like to thank the entire BCI team for inviting us today and for putting this available, or making this available. As Eugene said, I'm Mel Meltzer from Platinum Portfolios, and I'm excited to share some important updates with you from our side, including what's currently happening at Platinum Portfolios, and some reflections on the markets and some insights into how our portfolios have been navigating the current challenges in the market and the opportunities that we see in today's environment. Next slide, please. So Platinum was founded 25 years ago, and from the outset, our vision as a company was clear, and that was to protect and grow the capital of our private clients through a disciplined and independent investment strategy. We as a company operate as a licensed discretionary manager in South Africa and Mauritius, and we apply the same consistent philosophy across both jurisdictions. Over the last 25 years, our business has grown, and today our work that we do is supported by 85 years of combined investment management experience within our team. When we launched our business, our sole focus was managing money for private clients, and our focus remains unchanged. We believe the success of Platinum Portfolios is rooted in the strong and trusted partnerships that we have developed with independent financial advisors over the last 25 years. These partnerships, we believe, form the cornerstone of the success in our business. Our independence allows us to provide well-researched, thoughtful, and objective investment decisions, always with our clients' best interests in mind. The current team within Platinum Portfolios consists of myself and Sherilyn Pedler, the founding members of the company, and we've been joined by Stuart Green, who's been with the company now for over 3 years, who focuses on our multi-manager solutions. Stuart was previously with Alexander Forbes, and he has become a very important member of this team. Barry Steenkamp is our senior analyst for global equities and is based in Mauritius. We believe we've built a stable, focused, and experienced team that's committed to a disciplined and straightforward investment process. Just looking back and looking at the discipline behind any performance, there's a recent thought-provoking Audible book by Stuart Brand that you guys can all access for free, and which is a great listen, and it focuses on what he calls the maintenance race. The idea is simple but powerful. Maintenance is boring, and it's rarely glamorous. It's not exciting to think about it or to do it, but it's essential. Maintenance is what keeps everything running, and most of us, in some form or another, are constantly managing things, our homes, our teeth, our cars, our computers, and our businesses. From where we sit in Johannesburg, it's all too clear that the failure to maintain infrastructure can have disastrous consequences. So when we think about investing, we view it as very similar to sailing. It's a quiet, deliberate, behind-the-scenes, ongoing process. It requires planning, consistent processes, and great attention to detail. This discipline and this focus on maintenance is what I believe allows us to weather storms, especially during volatile markets, and to provide our clients with consistent long-term returns that they expect from us. This concept of rigorous maintenance came up recently at a Berkshire Hathaway shareholders meeting, last weekend, in fact, where the team discussed the potential impact on autonomous vehicles at Geico, which is a big part of their business. And the conversation focused about how self-driving cars are going to disrupt the traditional car insurance business. Currently, most auto insurance is priced on human error, how often drivers make mistakes and how serious those mistakes can be, and pricing that from an insurance point of view. But as autonomous vehicles become safer and less prone to accidents, traditional insurance becomes less relevant. In its place, a company like Geico needs to focus on product liability from the software side and from the company side, like Tesla and all the automated vehicles that we see coming into the market. This risk associated with software and hardware becomes the new frontier that Geico has to price. And Geico has started preparing for this shift. We believe it won't happen overnight, but the transition is underway. And it's a powerful example how the ongoing adaptation is necessary in both the insurance industry and in fund management. As Buffett reminded us 200 years ago, who could have imagined where the United States would be today, how people would move around, how they would work and live. So it's a dynamic world that we live in. Over the years at Platinum Portfolios, we've had to make decisions to sell companies, for example, Intel, General Electric, and Comcast. These were not easy calls, but our process raised some serious concerns and red flags. And while we are not immune to making mistakes, in hindsight, these sales of these companies have proven to be the right ones. Very similarly to what Charlie Munger says, those companies just became too hard to keep in the portfolios. So adaptation is key. And as Gary Player says, the more he practices, the luckier we get. Next slide, please. So let's go and dive a little deeper into the lessons that we can learn from this Audible book. The maintenance race refers to a real-life story, which is an epic solo yacht race around the world involving 9 sailors. Only one sailor, Robin Knox Johnson, completed the race. The book primarily reflects on the 3 distinct personalities of each of the sailors. Robin Knox Johnson was calm, process-driven, and meticulous about his maintenance. He reminds us of a consistent fund manager who follows a disciplined process and respects risk controls. Donald Crowhurst was innovative but ill-prepared. He lacked a solid foundation, cut many corners, and was ultimately dishonest. In investment terms to us, he resembles an over-leveraged fund manager with no ethics, no process, and no risk framework. He was a Bernie Madoff type character. The last sailor, Bernard Moticio, was a minimalist and self-sufficient and very impressive. very much like a passive investor who quietly endures and stays the course. So what is the key lesson to us at Platinum Portfolios? Daily discipline matters. Ongoing maintenance and preparation make all the difference. So we hold the same beliefs. Whether we're investing in direct shares or selecting underlying managers, our multi-manager strategies have to comply with what we understand. And we have to maintain that discipline in our selection in all market cycles. We always try and avoid complexity and over-engineered solutions. Our focus is building resilience, and this provides us with comfort during volatile markets. Let's not forget what Warren Buffett famously said, that the first rule of fund management is don't lose money, and that the second rule is don't forget the first rule. So just to summarize, maintenance matters, as highlighted by the yacht race. At Platinum Portfolios, we believe our discipline is rooted in the same beliefs. We have a daily discipline. We know our investments deeply. We maintain our process. We avoid unnecessary risks. And we believe this framework provides us with a mental resilience, especially when markets become tough, volatile, and turbulent. Over time, this disciplined approach has helped us deliver strong risk-adjusted returns, protecting our clients' capital while positioning their portfolios for long-term growth. Taking a step back, let's have a look at how we create our different multi-manager portfolios. Our asset allocation framework starts with building the efficient frontier. As you can see on the graph, the orange dots indicate where our portfolios are currently situated on the efficient frontier. We use a Monte Carlo simulation to test over 1 million potential portfolio combinations based on monthly real returns for each asset class since 2002. Every dot, as I said, you see on the charts represents a different mix of asset class weightings, and each one offers a unique balance of risk and return. From this universe, we identify the optimal portfolios that we believe will deliver the desired return at the lowest possible risk. Our strategic allocations for each of our RAND-based solutions are then plotted on this graph and aligned with the efficient frontier. Just going back to our fund range, we are very excited to announce that we are launching on the 1st of June the Platinum Balance Plus Fund of Funds, which falls within the CISA High Equity category. And we are now proud to offer a complete suite of funds and solutions to our clients. So these solutions will be tailored to investors with different risk appetites and return objectives. Our range includes everything from the Platinum Defensive Income Fund, which is a cash plus fund and designed for clients who prioritize capital, stability, and income, to a more aggressive portfolio at the top of the graph, the Platinum Worldwide Flexible Fund, for those clients who are seeking maximum long-term capital appreciation. In addition to this, we offer a multi-asset offshore fund, giving clients the option to diversify into hard currency and global opportunities. Going back to our investment philosophy, we are deeply committed to our process and continuously trying to improve it. We only invest in things that make sense to us, that we believe will deliver good long-term returns. We keep things simple in everything we do. We buy quality companies, and we do the same when allocating money to underlying fund managers within our multi-manager solutions. We only invest in fund managers with strong leadership, good fund management teams, proven track records, and companies and fund managers that we believe have a durable competitive advantage. Once we've invested in our underlying assets, it's our intention to hold these positions for the long term. This discipline is what we believe enables us to deliver the best possible outcomes for our clients. So going back to our private client base, Our investment process allows us to produce good risk-adjusted returns with the least amount of risk. It's our experience over the last 25 years that clients generally only phone our office when the market's down. Rarely, or if ever, do we get any calls from clients after a strong investment quarter. That tells us something very important. Capital preservation is the cornerstone of our investment philosophy. With this in mind, I'd like to briefly review the performance of our funds over the last 5 years and reflect on how they've delivered on this promise. We don't really want to make comparisons to different funds in the sector. So I'm just going to focus on the downside risk, or the volatility on the downside of our different solutions. And if you look at the Platinum Income Fund against the background over the last 5 years, where the biggest drawdowns on the S&P have ranged from 33.7% down to 24.49% in January 2022 to December 23. So you can see that the fund has held up in difficult markets. And if we go to our next fund, the same applies for the Platinum Balance Fund, where the fund's downside risk was only minus 6.3. And if we go further to the next fund, you'll see the Platinum Worldwide Flex during that 5-year period only came down by 11.2%. If we look at the Platinum Global Fund, which is purely US dollar based, the fund during that period, the worst drawdown was only 14%. And compared to the market itself and some of the peers in that sector, we have managed to not lose too much of clients' money on the downside during this period. And this just gives you an indication of how go back to that previous slide, indication of how the Global Fund performed from August 24th to 28th of April. And that we are very proud of the fact that that fund has managed to weather the market during difficult times. Yeah, so lastly, I just want to thank you once again. And then anybody that's interested can go to our website, it's platinumportfolios.com, or they can contact Sherilyn, myself, or anybody in the team if they've got any further questions. Thank you, Eugene.
No, thank you very much for that. I do want to get a little bit more into your asset allocation views in some of your funds. But before we do that, we've got Anthea standing by on the line as well. Anthea, you can share your presentation if you are ready.
There we go. I'm ready.
Yeah, absolutely perfect. We're ready for you. Mel, if you can stay on the line, we'll do the questions after Anthea's presentation. And I'll keep an eye out for questions from the audience as well. Anthea, thank you so much.
Super. So let me get going. Right, so many of you have met me before, been on these presentations, but for those of you who haven't, I started Cartesian Capital 10 years ago. I named it after the French philosopher and mathematician René Descartes, who you'll know for saying, "I think, therefore I am," and whose mathematical legacy includes the Cartesian plane, or, you know, the plotted X, Y axis, as you can see in the right-hand side of the slide. He also did subscripts and superscripts, so X cubed or squared, that's a superscript. And the numbers you see in the top right-hand corner of my slide, if you put those into your navigation system, it'll bring you straight to our offices. So today I want to talk about an overlooked but very important asset allocation, and one that I believe we currently have too little exposure to in the world or the economic situation that we find ourselves. You know, we're always kind of chasing high returns for clients. And what I want to talk about today is real yield. In other words, a return above inflation. So here you've got the blue line, which shows the repo rate, and the gray line, which shows headline inflation, or CPI as we know it. And my point I want to prove or show you is that not in the last 10 years has the difference between the repo rate and headline inflation been so high. And what we want to do is, when we're investing clients' money, is really think about affording investors low risk with decent returns. And in this case, you can invest in very low risk, like money market funds, with about 5% above inflation. Now, we definitely distinguish between strategic and tactical asset allocation. And this is very much more a tactical asset allocation opportunity. There are a couple of things that will change this, and don't get too intimidated by this graph. It is simply showing how the forward rates market has changed and is now pricing in a 60 basis point rate cut in the next 9 months. So the red dotted line is the 3-month JIBAR. The light blue line is where the market was on the 1st of January this year. The gray line is where it was on the 28th of Jan, so almost showing that the market was possibly looking for a rate hike, a small one, but still, as you can see, a line above that. So what it does, the forward rate market, is actually predict where they think interest rates are going. And then, of course, the dark blue line, this was taken on Monday, and showing that we're expecting a rate cut over the next couple of months. In fact, we're expecting 2 rate cuts this year. So, of course, this will change the outlook or the tactical asset allocation strategy or opportunity that I'm showing you a little bit. This is our the performance of our Cartesian BCI money market fund since inception, which is possibly our lowest volatility fund. Of course, I look at volatility as a risk measure for clients. And the risk is that the client will need to withdraw their money when the markets are going through a negative spell, as we've seen of late, or going through huge volatility. And, we're not trying to time the market. We're just showing that you can give your clients a decent short-term opportunity of making real yield without the risk of having to withdraw their money when the market's down. Now, I'm going to sound a bit like a stuck record when I say this, but when you're thinking of investing in fixed income, you need to know or you do know what your yield is when you're going or when you're buying the instrument. So upfront, you know what your yield is. And the 2 things we need to watch out for are default and mark to market. Now, I can do very little about mark to market, but I can ensure we buy quality instruments. And in my opinion, the South African government is not going to default anytime soon. So have a look at this graph of the 10-year government bond. The bars are the fair value estimates, and the orange line is where the 10-year government bond has traded on those given dates at the bottom. So based on fundamentals, last year, 10-year government bond was trading fairly cheaply with a yield of 12.22%. Now it's a little bit more expensive. So at 10.58%, it's, I think, about 16, I have that somewhere, basis points below the fair value. But the reality is that you're still getting, if you're buying 10-year government bonds, you're still getting approximately 10.58% per annum with very little risk of default. And sure, the mark-to-market can add risk to your client's portfolio, but it's not nearly the type of risk or volatility you're seeing in the equity market at the moment. In fact, we did the numbers yesterday. And in the last 50 days, with all the Trump tariffs and all the noise, the all-share volatility jumped to almost 24%, while the volatility on the 10-year government bond was just about 12%. So you can see how, and even though things kind of, if you look at it at the beginning of the month and the end of the month, not much has changed, right? But the in-between volatility, and you don't know when your client's going to withdraw the money, is what we are really trying to talk about. This is just another slide to show you that we've got a fairly or relatively liquid and stable inflation linkers market in South Africa. So you can also get good inflation beating returns from that. So now there's so many things that will influence this trade. I really had to choose one. And And I've chosen to talk about something that has been occupying my mind for the last 2 years, because I was really trying to get my head around this idea of de-dollarization. And the fact that Warren Buffett brought it up over the weekend when he replied to a question about why Berkshire Hathaway had so much exposure to the yen, part of his answer, or the follow-up kind of question answer, was that he doesn't want to be invested in a currency that is going to hell. Those are his words, by the way, not mine. Yeah, so we've been talking a lot about de-dollarization and whether it's a real thing. So have a look at this graph. It shows, or the graphic, I should say, that's not a graph, it's a graphic. It shows that the smallest amount of global trade is in fact transatlantic trade at only 14%, while Asia holds 34% and Europe 38%. And for those of you that are quick at maths, the balance of the 14% is scattered around other regions, right? And we'll talk a bit about that in a minute. But possibly the most important point to take from this is that the trade wars are likely to shrink the US's trade even further. And if the US does go into recession, or it loses its status as the largest economy in the world, what happens next? Have a look at this picture. It's the largest solar farm in the world, which went live in June of last year in China. It is the same size as New York City. The picture you're looking at now is a city called Chongqing, which is situated on the Yangtze River, and is now the largest city in the world by population, with 30 million residents. And it's a municipality, so it's not just the city center, it's also the area around it. But it also happens to produce half the world's laptops. So unfortunately, it also has the very dystopian reputation of being the world's most surveilled city. I'm not sure that's even a word. It should be, because earlier this year, authorities installed 28,000 surveillance cameras and 245 sensors as part of grid surveillance to keep tabs on their residents. And the reason I bring this up is because as Westerners, I think this kind of thing freaks us out. You know, we like our freedoms. We don't want to be watched like Big Brother. And so we remain skeptical of the Chinese authorities, their behavior, the economic data that they show us. But my point is that the facts remain. There we go. And this is my last slide. So over the last 10 years, China has steadily been de-dollarizing. Finally, in March of 2023, more of China's cross-border transactions were settled in renminbi than in US dollars. So does this mean the renminbi or the yuan will become the next safe haven currency? Now, you see, I'm not convinced. And exactly for the reason I mentioned earlier, that as Westerners, we're skeptical of Chinese authorities and the economic data they show us. And quite frankly, the reason the dollar has lost its safe haven status is the same for Trump, right? We're unsure of what the president of the US is going to do next. And so everyone's nervous in what's going on. I don't have a slide for this, but I think this really leaves or begs the question, you know, does this leave it open for the BRICS currency? Firstly, I don't think we as the BRICS countries own a large enough percentage of global trade. And secondly, I don't think de-dollarization happens overnight. You can see from this graph that the Chinese have been de-dollarizing for the last decade, and we haven't even begun to establish a BRICS currency. So I think it leaves open an opportunity, but I don't think we're going to see it in my lifetime. And that's my presentation, Eugene, if you have any questions.
Thank you very much for that. I find the whole conversation about the dollar fascinating because, I mean, all portfolios have some sort of exposure to the USD. And I mean, if we step 3 months back, I think a lot thought that the US dollar would potentially remain stronger for a little bit longer. There was even talks about, you know, Trump wants a weaker dollar. How's he going to establish that? Because trade tariffs implies inflation, volatility, and then people normally flee to the dollar. The opposite is exactly happening. even currencies like the rand improving significantly relative to the dollar. So interesting that the dollar is losing value in uncertain times, and we also seeing, some flight to the Swiss franc. A lot of clients moving to the yen also as a safe haven currency. But what do you see as a safe haven currency? So if you were to play the currency game, what would you back? Where would you go? Maybe Europe, the euro, the pound?
I'm happy to take that question. So, the Swiss don't want a stronger franc. And over the global financial crisis, you'll probably remember when the US got downgraded from AAA eventually to their kind of global risk-free status, everybody fled to the Swiss franc. And what the Swiss National Bank did was it put a cap on the Swiss franc, which like shocked the world, And so basically they were protecting, if you want, their currency. And so I don't think it can be this. I think short term, yes, investors will run to other safe haven currencies like Swiss franc, but that's a short-term trade. Same story for the Japanese yen. There's no doubt the Japanese economy is coming out of this massive slump, and I would definitely, that's where I want to be invested. And again, if you're going to be invested in Japanese companies or the economy, you have to buy your Japanese yen. And again, the Japanese don't want the strong currency because it's exporting for its exports. And so unfortunately, I think the US dollar is going to stay a relatively safe haven currency for a couple of years yet. But my point when I talk about de-dollarization is that it is changing. And so where would I be invested? I've never liked the euro. I've never understood how it can work with so many different economies and so many different growth stories or non-growth stories, as the case may be in Europe. I sit in South Africa and I invest predominantly my South African rands. I'm going to be quite happy to be sitting in rands this year, Eugene.
Indeed. Mel, if I could maybe get a little bit closer to your asset allocation, if we could maybe start with your worldwide flex fund, and I'm going to stay with things, how currencies can impact. But before we do that, if we can maybe just get some sense of your asset allocation in the worldwide flex. As I have it, your offshore equity is sitting roughly at about 65% with very low exposure to SA equity. Over the past couple of weeks or months, we've had lots of very compelling arguments on SA equity, offering, trading at very attractive valuations. And some particular companies, also very defensive in uncertain times and still showing good growth in earnings. You clearly have a big overweight position in the worldwide flex. Maybe just give us a sense, when you approach asset allocation worldwide flex, is it meant to be skewed more towards global assets, or why the high allocation to offshore at the moment relative to SA?
Well, going back to Anthea's comments about currencies, I don't think anybody can predict what currency is going to be the best performing currency over time. So from our point of view, we invest in multinational companies because multinationals have got a footprint around the world and they earn income streams in all different types of currencies. So we feel that's a built-in hedge against currency volatility and the changes within currency. So our preference is to buy the best companies we can find, and whether they're in South Africa or offshore, we prefer multinationals because of their footprint and because of their competitive advantage. So to us, that's always made sense to find companies that fit into what we want to invest. So the fact that we've got quite a big exposure or overweight exposure to offshore equities of around about 64.7, 65% is purely the result of those multinational companies that we want to own for the long term. So locally, we find the environment quite difficult to find companies that tick all the boxes in terms of what we're looking to buy. So I think that is really the reason why we've got that type of exposure.
How do you think about currency overlays within the worldwide flex? I mean, are you concerned about short-term dollar weakness that might impact on overall returns?
No, we're not concerned about it at all. We don't use any overlay strategies or any hedging strategies whatsoever. As I said in my presentation, we like to keep things simple. Yeah, so we're not concerned about it at all. In fact, for the multinational companies that we own, a weaker dollar is good for them. It stabilizes their earning streams. Yeah, so we're not really concerned about it at all. We're taking a much longer term view on the companies that we hold. And in fact, we believe that the only way to hedge yourself is to buy great companies that will hedge you against dollar weakness, any other currency that's affecting the value over time. You know, if you look at the US, the dollar is devalued by 8 times since 1946 or 1947. And the only way to hedge yourself against that is to find great companies to invest in.
European markets appear to perform well relative to the S&P 500 over the past 3 months. Do you venture into other markets like Europe or even emerging markets on your global holdings, or do you only focus on US?
We only focus on multinational companies that are listed on the S&P 500. That's our framework. We believe it's big enough. But as I said, you know, companies that we own, Philip Morris, Johnson & Johnson, and these companies have got footprints all around the world, Europe, Asia. Some of the medical companies we own, like Medtronic, have got operations all around the world. So, you know, we don't invest in European stocks because our framework is the S&P 500.
Now, if I look at your global carve out relative to the S&P, it's done significantly well. So the strategy somewhere is definitely working. Question from the audience, Mel, I'm going to stick with you. And it speaks to Warren Buffett's large holdings in cash. We all know about that by now. You know, is this, do we need to read more in this? Is there concerns regarding potential global stock market declines?
I think it's quite simple. You know, if we all know that on every single metric, market valuations are very elevated, and on Warren Buffett's favorite metric of the GDP growth of a company versus the market cap of the S&P, the market is trading at elevated levels. And so that is most probably the only reason why he is sitting in short-dated treasuries. He's sitting in short-dated treasuries because he's getting a good yield on his money. And he as an investment manager, in terms of his style, he will not employ any capital unless he finds those opportunities. So I think that is really the reason why he is sitting on so much cash, in inverted commas. And that's why we have a lower equity allocation, because currently we can't find many stocks that are trading at values that make sense to us. We will not buy companies, even if they are some of the best companies. I mean, I'd love to own Costco and companies that we really like, but they're just too expensive. So we're going to have to be patient and wait for those opportunities. Because as we all know, if you overpay for an asset and the price earnings ratio unwinds, even though the company continues to do well, it can do a lot of damage in your portfolios.
Anthea, just very quickly back to the dollar, and I'm trying to understand the impact of the dollar perhaps on US bond markets. But what does a weaker dollar mean for US bond markets? And then, you know, ultimately, where is the SA bond market going?
Sure. So I'll start with SA. The problem with SA at the moment is our economic situation. You know, we're very close to that, very close stagflationary environment where you've got high interest rates, you don't have high interest rate, high unemployment, low GDP growth, and the only thing that's stopping us from being stagflationary is the fact that we now have this low inflation, which is going to help us. So I think the situation that we're in at the moment can help us, but we do need to do something about the economic environment, because I think this will keep our interest rates higher, you know, our borrowing cost high. The US market, there's a lot of talk about weaponizing US treasuries against the US, but I don't, and actually the graph shows that China has already sold off so much of its US treasuries that I don't think it's going to be an absolute disaster. So even though you've got a slightly weaker US dollar in the short, or even more than slightly weaker dollar in the short term, I think US treasuries, it's probably a good opportunity to buy US treasuries at this level, because I don't think people are going to sell it off just yet. And I know we talk about moving from a safe haven asset such as the US dollar or US treasuries, but it doesn't happen overnight. So short term, I think you can comfortably buy some US treasuries. And in fact, even South African bonds are offering such good yields. I don't know why you wouldn't, really.
And the reason why I'm asking this is we know that the Reserve Bank is extremely conservative, and that they haven't decoupled yet from US rate movements. And if US yields were to stay higher for longer, and I hear you saying, you know, we're expecting 2 rate cuts potentially for this year, who knows? But could it mean that, and you showed that graph where, you know, our inflation rate and where our nominal yields are sitting, that gap is too big. We all know, and we're all saying that the SARB could have cut rates already a lot more aggressively, but they're too scared for, you know, potentially Iran blowing out. But if the US yields remain high, do you think that SARB could start moving a lot quicker than the Fed?
Eugene, I think if the SARB was listening in, they'd be very upset with you. They'd like to think of themselves as independent. And yes, we know that they're very hawkish. You know, you're always hearing the governor saying that inflation is the enemy of the poor, and we live in a very poor country. So, and there's so much talk about, yes, they should have moved sooner. And, you know, their mandate is kind of their primary mandate is inflation and market stability, and they see that market stability being part of not protecting your currency, but ensuring that your interest rates work in your favor. And a stronger rand obviously is good for inflation, and money flows. There's so many arguments around this. Money flows to higher yield. And so will they cut interest rates while the US is fighting a higher inflation? Luckily, we've got low inflation, so they can do that.
Yeah.
I hope so. You know, I do hope that they'll cut interest rates. And let's be honest, the South African government needs all the help it can get to boost GDP growth. And I think it will help. But I think the SARB is hawkish, and the MPC are hawkish, and they like this low inflation environment. You know,
Only time will.
Exactly. And that's why I think, Eugene, you've got such a great tactical asset allocation opportunity. And even the previous question about sitting in cash. I mean, if you're sitting in low risk, probably above inflation yielding instruments such as money market or income funds, then there really shouldn't be a problem. You should be fine. Your clients should be fine.
Mel, just quickly in terms of your portfolios, both the worldwide flex and the balance. We know the balance is in the medium equity. You mentioned the balance plus coming on board, which is in the high equity category. But how do you see US bonds or US Treasury yields at the moment? Does it find a place in your portfolios as a hedge against current volatility?
No, I tend to agree with Anthea that the current environment where we want to generate real returns for clients, specifically in our lower risk solutions, buying South African bonds and high yield instruments, you are getting a great real return and you're not taking a lot of risk. In terms of our exposure or our barbell approach to holding short-dated instruments locally and offshore, we only holding those instruments because we can't find anything else to buy. So, and we're still getting a good yield on our money. But in South Africa, we're getting great yields relative to the risks that one faces in equities locally because of low growth, because of all the stakeholder interests and the drag on returns. So for us, it just makes sense to us to be patient, get a good yield locally, get a reasonable yield offshore, and wait for opportunities.
I'm going to put you on the spot here. On a relative basis, do you think that in the short to medium term that SA fixed income can potentially give you better returns than SA equity?
I think there's an absolute case for that. I mean, if you're going to look at the longer term returns, the high yield funds over time, over 7 years, have done particularly well, where equity managers have performed well, but the high yield funds in most instances have outperformed equity managers in SA. And I think that trend, taking into account the low GDP growth, the high debt levels in South Africa, I think that trend is going to continue. But more important to us is the fact that we can get a real return for clients way above our targeted returns in our funds by buying those instruments or buying those yields without taking a lot of risk.
Anthea, just very quickly on your money market fund. I mean, we spoke about SA bonds offering attractive yields, potentially two rates cuts coming through for 2025. But again, time will tell. We'll see how quickly this hard moves or don't move. But despite that, I mean, we know that SA bonds offer very attractive yields. You're very limited in a money market fund to access a lot of those opportunities. How do you go about it in a money market fund to make sure that your clients actually get the best possible yielding?
So one of the things we do, Eugene, is try to think about where we think interest rates are going, and we will position our money market fund using two things. That's the fixed versus floating rate instruments. So obviously in an interest rate falling environment where interest rates are coming off, we want to be predominantly in fixed rate instruments. So we know exactly what we're getting. We can invest up to 13 months in fixed rate or on any instrument in the money market fund, for example. So if we can buy those instruments at this yield and interest rates come down, we know what we're getting. And then secondly, of course, duration is the other play. We do also manage other funds. We've got an interest plus fund where we can do a little bit more, and a fixed income hedge fund. And so to your previous question, the fixed income hedge fund, for example, launched last year, January, and we're very proud to say that we've only had one negative month. And so back to this question of getting real yields with low volatility. And that's kind of what you're getting in the money market unit trust that we have with BCI.
Thank you very much. Yeah, and Mel, I'm going to park it there with the clock brought up to us. For the audience, the Platinum portfolio, as Mel showed you, the whole fund range available on most platforms. So if you're looking for solutions for your clients that are very much also focused on risk management or the downside protection for clients, Mel showed all those graphs as well. Do make contact with Platinum Portfolios if you want more information. And for clients that are very sensitive to short-term volatility, don't forget about money markets. It can be a good place, very attractive yields at the moment to park money and to keep some dry powder. Anthea and Mel, thank you so much for your time this morning. It's always great to have you on board, and we'll chat to you again in the very near future. For our audience out there, just a quick reminder, next week, Wednesday, no boutiques on Wednesdays. And why? Because we've got the BCI Global Investment Conference next week. Monday is the online session with all the offshore managers. It's going to make for some very, very good conversation, very interesting views, especially where we are currently. And then Tuesday and Wednesday, we've got the hybrid events, broadcasting live from Pretoria this year, not Cape Town. So looking forward to seeing a lot of you at the Pretoria venue. And for those who can't make it there, the online session's still available if you want to register, if you haven't done so already. Looking forward to seeing you all next week. And we'll continue to unpack what the world and fund managers can offer to you and your clients. Our audience, thank you so much for joining and your continued support. Always great to have you with us. Until we'll see you next week. Keep well.
Thank you very much.